Hello friends, in this video we will learn about characteristics of bonds. Let's see one by one what is the characteristics of the bonds. Principals amount, the total investment made by a bondholder on the bond. Number of years of maturity, 1 year, 5 years or 20 years, etc. Contract interest rate. It refers to return on the bond based on the contract. The same is printed on the bond. Market interest rate. It refers to the interest rate prevailing in the market. Interest payment schedule. Annual bond, semi-annual bond, quarterly bond or monthly bond. Let's see next slide. Bond versus stock. What is the difference between bonds and stock? Let's see in this slide. Bonds. Bonds issue of debts. And stocks are issue of the stake of the ownerships in the company. Second is debt that is made with investors for cash in exchange for payouts of the interest. And in stocks, a claims to a company assets and earning that often gives the investors voting rights and pay dividends. Third point is typically traded over the counter. It means OTC. And in stock, typically traded through a central exchange like a NYSE. Since 1929, have earned around 6% each year. In stock, generally higher risk, higher reward, and can be made as corporate, municipal or treasury bonds. In stocks are issued by companies at a stock exchange as IPOs. Types of bond. Let's see types of bond. Bond on issuers, first type. Second, based on collateral. Third, based on maturity. And fourth is other types. Let's see one by one. Based on issuers, government bonds, corporate bonds, municipal bonds. Based on collateral, secured bond, unsecured bond. Based on maturity, zero coupon bonds, perpetual bonds, deferred bonds, callable bonds, puttable bonds. And other types, convertible bonds, foreign exchange bonds, inflation indexed bonds and junk bonds. These are the types of bonds. Next, see one by one deep knowledge about it. So first is based on issuer. Government bond. These bonds are issued by national government to finance their operations or projects. They are generally considered low risk investments because they are backed by the government's ability to tax or print money. Examples include US Treasury bonds, UK gilts and German bonds. Second is corporate bonds. These bonds are issued by corporation to raise capital for business operations, expansions or acquisitions. They offer higher yield compared to government bonds, but also carry higher risk. The creditworthiness of the issuing companies plays a significant role in the determining the bond risk and yields. Third is government bonds. These bonds are issued by national governments to finance their operations or project, and they are generally considered low risk investment because they are backed by the government's ability to tax or print money. Examples include US Treasury bonds, UK gilts, or German bonds. Let's see second, based on the collateral, secured bonds, unsecured bonds. A secured bond, also known as a mortgage bonds or asset backed bond, is a type of bonds that is backed by specific assets or collateral, and these bonds offers investors an added layer of protections in the event of default by the issuer. Unsecured bonds, also known as a debenture or a non-secured bonds, is a type of bond that is not backed by specific collateral or assets. Unlike secured bonds, unsecured bonds rely solely on the creditworthiness and ability of issuer to make the promised payments, including principals and interest to bondholder. In a secured bond, the issuer places a specific asset as a collateral to secure the bond, and these assets can include real estate, equipments, inventory, or other tangible assets that have value. The issuer grants security interest or lien on the assets, which means that if the issuer default on the bond payments, the bondholder have claim on the collateral to recover their investments. In case of unsecured bond, investors do not have claim on specific assets of the issuers in the events of default. Instead, bondholders have a general claims on the issuer assets and earnings. If the issuer defaults, bondholders become general creditors and may have to wait in a line alongside other creditors to recover their investments. Next, based on maturity. Zero coupon bonds. These bonds do not pay a regular interest like a traditional bonds. Instead, they are sold at a discount to their face value and provide a lump sum payment at maturity. The difference between the purchase price and the face value represent a return on investment. Perpetual bonds. With perpetual bonds, the agreed upon period over which interest will be paid is forever, as perpetual bonds live up to their name and pay interest in perpetuity. In this respect, perpetual bonds function much like dividend paying stock or certain preferred securities. Just as the owner of the stock receives a dividend payments as long as the stock is held, the perpetual bonds owner receives the interest payment as long as a bond is held. Deferred bonds pay interest only upon maturity. Like most deferred bonds does not make a periodic or a coupon payments over its lifetime. Instead, the interest accrues is paid out when the bond expire or mature. Next is based on maturity. Callable bonds, puttable bonds. Callable bonds gives the issuers the right to redeem or call back the bond before the scheduled maturity date. The issuer typically exercise these options when interest rates have declined, allowing them to refinance the debt at the lower cost. When a bond is called, the issuer repays the bondholders the principal amount plus any applicable call premiums. Callable bonds often offer higher yield to compensate investors for the risk of potential early redemptions. Puttable bonds, also known as retraceable bonds, grant the bondholder the right to sell the bond back to the issuer before the maturity period or date. This option benefits the bondholder in situations where interest rates have risen or if they need liquidity. The put option allows bondholders to receive the principal amount back from the issuers. Puttable bonds may offer lower yield compared to the similar non-puttable bonds, since the put option provides the bondholders with additional flexibility and downside protection. Other types In other types, we covers four types. First is convertible bonds. Convertible bonds gives bondholders the option to convert their bonds into the predetermined number of the issuer's common stocks. They offer potential for the capital appreciation if the stock price rise, combining feature of both debt and equity instrument. Second is foreign bond. Foreign bonds are issued by foreign governments or corporation in currency different from that of the investor's country, and these bonds can provide opportunities for diversification but also carry currency exchange rate risk. A junk bond is also known as high yield bond, is a type of the bond that carries higher risk of default compared to the investment grade bonds. Bonds are issued by companies or entities with a lower credit ratings or a higher profitability of the finance distress. Inflation index bond. Inflation index bond are bonds where the principal or interest is indexed to inflation's and retail price index. They are thus designed to cut out the inflation risk of the investment. An inflation indexed bond is a security that guarantees a return higher than a rate of the inflation if it is held to maturity. Inflation indexed securities link their capital appreciation or coupon payment to the inflation rates. Thank you so much for listening this video. Thank you all.